Last week on Economy Lately.
South, this is awesome. This is the best universe yet.
Hand over the economy lately at once before my dinosaurs destroy everything. South, we have to leave. We can't stay here anymore.
It was so nice, though.
It was nice, but the other guys showed up. Anyway, Robot South, you and I, we're heading out of here. Hello, everyone, and welcome back. I'm Anthony Smith, Chief Economist here at FreightWaves, and this is the Economy Lately. I'm joined by the one, the only South Turk as well.
Hey!
And this is episode 20.
Episode 20. Woo!
And you might be thinking, South, if they do keep up, that what happened to 19?
Yeah, well, we're going to say we had episode 19, and it was the best episode.
It was amazing.
It was, we were definitely going to get nominated for a regional internet Emmy.
We had sponsor talks going.
Yeah, like serious sponsor
Big
talks.
sponsors.
Big sponsors, yeah. Uh-huh.
But we just forgot to hit record?
No, I think they just forget to hit the record, hit the broadcast button on FreightWaves now. I'm pretty sure.
We forgot.
Yeah. You know those.
Forgot to hit the broadcast button on FreightWaves Now last Friday.
Yeah. They were too obsessed with their new communication systems and forgot to actually press broadcast.
Interesting. That's a lot.
Television 101, guys.
Those guys. Anyway, enough about the boiler room boys. We got a lot of catching up to do because there was that little minor setback, and we got to catch up to what happened as of last week and going into this week and all the latest. So let's jump into it with our first update, and that's going to be around durable goods new orders. Kicking off with durable good new orders, we saw that overall that there was a downward movement of 0.2%. Now, this doesn't seem like a big deal, and I wouldn't really write home about this one yet. But when you look underneath some of the report, you start to see some of the trends that's happening right now. So, for example, year-over-year growth is still steady and on pace for holding up right now. I say that this segment is facing headwinds, and those headwinds will be coming from, of course, those Fed movements where there have been increases in interest rates. 75 basis points was the last movement, and it doesn't come as too much of a surprise to the market or anyone else. I think this was the expected movement that we were planning to see, but this is going to make it a little bit more expensive for capital good expenditures. Core capital good expenditures new orders, or non-defense capital goods new orders, moved up 1.3% in the most recent month, showing that businesses are still making purchases. Like I said, this is likely going to slow down with a little bit of a headwind coming from those increased interest rates. It's going to make it a little bit more expensive to purchase these capital goods on credit. So that's going to be one of those areas that we're going to watch closely. And of course, South has a little bit of flow try. Just a little bit.
Okay,
yeah,
just
a little bit.
The only one, right? What? You at least can lie to me.
No. We got to talk about something else. While we're on the topic, we also have to talk about housing and construction, South, because so new home sales. This is one that rose a staggering 28% on a month-to-month basis. Now, this increase is going to come with some of the caveats, and we're going to jump into that. But when we're looking at housing and construction and this upward movement, we saw that this surge is going to come with some, side notes. So despite the double-digit increase, we saw that sales on an annual basis are still down 0.1%. There's also an 18.3% confidence interval for this release, which is showing that it's likely going to be subjected to revisions in the coming month. Also, this is another one where we saw and expected that increased interest rate, and this could also indicate that there are last-ditch buyers or would-be home buyers looking to push those home purchases forward before those interest rates do increase, and in fact, bumping up those mortgages as well. That's going to be one of those areas that we're going to be watching closely, in addition to, of course, that new orders and durable goods orders. And like I said, South, this has implications for FOTRI ever so slightly. When we look at FOTRI, it's still moderating at a pretty much high level, and it's showing that there's still a lot of activity going on relatively to where we saw, of course, in 2019, which was yikes. But Anyway, we're still seeing that there is still some movement, but I'm not confident that the housing market or housing construction is going to be standing up too much longer. We are starting to see home prices come down and inventory levels right now. We're looking at existing home inventories. This is going to be much bigger part of the housing and really infrastructure. So new home sales, great. Love to see it. Existing home sales is going to be over 90% of the home transactionary market. So we're looking at existing home sales. This is going to make up much bigger portion of the pie. So when we look at existing home sales, this is going to be somewhere of a slowing down because we're seeing that those people that were able to buy those homes, those existing homes or new homes, which are now existing homes, even though they were once new. Anyway, when you see those homes now being purchased, they're going to be at a higher mortgage rate level. Those homeowners are now able to have locked in those historically low mortgage rates, are going to want to hold on to those. So they're not going to want to sell those homes and be subjected to a higher mortgage rate and even trade up or trade down in a home. That's not going to be an option for them right now. So that's going to keep the inventory level a little bit lower. Not going to see a whole bunch of selling off in terms of people trying to get rid of their homes just yet. We're going to see a lot of people try to hold on to their homes just so they can make sure that they have those historically low interest rates locked in. Next one that we got to talk about is going to be job openings. And this one was nasty. We saw that there was a drop of 1.1 million jobs in the most recent job openings report, now hovering in that 10 million range. And that's a sudden movement. That's down over 6% on a month-to-month basis. And there was also a slight uptick, but nothing too alarming yet, in layoffs. And so this is going to be one of those areas that we were talking about. And I'm not going to use this as a, we told you moment, we called it. But it doesn't look too good. We are still seeing that the initial jobs claims are in somewhat of a decent place right now, but we'll be continuing to watch that. And I'm not going to call this a trend just yet because it's just 1 month of movement, but it is certainly concerning. We're looking at the jobs market. This is going to be one of those areas that has implications to freight, of course, because an employed consumer is a buying consumer, and a buying consumer helps feed the overall economy and also draws in freight demand as those goods have to get moved throughout the country. Overall, when we're looking at the jobs market, this is going to be a lagging indicator for job openings, but take it like this. If the economy is slowing right now with job openings really being where they are and record levels or near record levels of unemployment, can you imagine the type of contraction that we could potentially have if there is a sudden shift in the jobs market? That's going to put a lot of consumers in a much worse position. One of those other areas that we're going to be watching in the upcoming week that's going to be released as of the time of this release for Economy Lately is going to be consumer credit utilization. A lot more consumers are continuing to utilize those credit cards, and it's going to be putting them in a bad place, especially if more layoffs start to happen, and that puts them into a bad position. Next thing you know, the Fed is increasing interest rates. People are losing their jobs, but now they have record levels of debt. And you also see that the savings rate is not where it was before the pandemic. This is not a recipe that you really want to have baked in going into the new year. So all those are going to be things that we have to watch in the upcoming week. Speaking of the upcoming week, we're going to have to keep our eyes out on retail sales, which is going to get updated next Friday. We also have the CPI report, which is going to show how inflation is really hitting consumers. And then we also have, so this is going to be rich.
Oh, yeah?
And we have the Fed releasing their 5-year inflationary outlook.
Wow.
Yeah.
5 years.
Yeah.
What, they got like teams of fortune tellers and palm readers and tarot card people like predicting that stuff? Or
I mean, at this point, they should probably go that route because whatever they've been doing just hasn't been working right now.
Hey, let's say this doesn't work out. We don't get a sponsor, whatever. What about a new show on FreightWaves Now where we do like psychic readings of the economy? Yeah.
Well, economics is a social science.
You're right.
And so I guess we would be in our lane, right?
I believe so.
Yeah, let's do it.
Yep. All right.
Let's get Todd on this.
Okay.
All right. We'll see you on the next show. We got to flesh out a few ideas, but we'll see you next week. This has been an amazing time with you all. Shout out to Brian Carrier and Minor Carriers. Appreciate you, my guy. And we'll see you all next week.